But we also have Mr. Parag Thakkar, Senior Fund Manager at Fort Capital, now joining us. Mr. Thakkar, afternoon. And since we are talking about the banking sector, your thoughts on the entire BFSI space. Did second quarter earnings stand out in your opinion, and is the trajectory likely to improve going forward?
Yeah, actually, banking results were far better than expected because they had to pass on 100 bips of repo rate cut in last two quarters, and this quarter was the major impact quarter. But SBI kind of bank or a federal bank, they all surprised. Even ICICI Bank on the core beam side, DCB, all these banks, City Union Bank, all these banks actually reported improved margins on QOQ basis. That is because because of RBI's improved liquidity into the banking system, and second, because these banks have managed it very well on the deposit side and deposit repricing, and that is because of this RBI's liquidity thing that they were able to reprice the deposits at lower rates. And that is why we saw, plus some of the banks like I would like to highlight that SBI and Federal Bank both focused on car improvement. For example, in case of SBI itself, in such a large loan book of 44 lakh crore with a credit cost of only 0.39%, their car grew by 18% YOY, which is not an easy task. And their fee income grew by 25% YOY. So I would say that I was pleasantly surprised with SBI's results, particularly, plus Federal Bank, which also focused on these two things only: current account and fees, and of course, credit costs remain contained. So I would like to say that yes, overall banking results were very good, and SBI has guided for higher credit growth of 12 to 14% from here on. Plus, they have also said that margins will see a U-shaped recovery from 2.97% in this quarter. So unless there is another rate cut, I would say. So I feel that banking, and just to take you through the other sectors also. For example, L&T reported highest ever order inflow, 1,15,000 crore in this quarter. They ended this quarter with 6,67,000 crore order book. So that tells you the shape of the economy. Even on the rural side, M&M and Escorts both have set 11 to 12% tractor volume growth, which was earlier 5 to 7%. So that is also indicating that rural recovery is taking shape. Even FMCG side, Marico reported 7% volume growth, and HUL has said that things will recover from November. Because right now, due to GST disruption, there is a problem in the system, but it will gradually recover by November. And within this problem also, Marico reported 7% volume growth. So I would like to say that corporate India is doing extremely well.
Right.
Wherever you have a very high yielding loan book, like what Bajaj Finance had,
Right.
there you will see some problems, which was MSME unsecured, as you saw. But otherwise, overall, corporate India has done brilliantly well.
All right, so corporate India has done very well, and we'll discuss each of these sectors in just a bit. But before that, we need to slip into a short break. Mr. Thakkar and Mr. Sinha, stay on with us. Coming back to you then, your thoughts on the entire consumption basket. GST 2.0 led to some disruptions in the second quarter, but management commentary is very positive. What do you make of this consumption uptick that we are expecting?
I think it's common across all the consumer companies that they are expecting a better second half. I think they have actually been grappling with a very slow demand scenario over the last several quarters. And if you look at the FMCG index, has been flat over the last 1 year. I would say it has not really performed in the last 3-4 years. So I think expectations have been around a turnaround in consumption for quite some time. It does look like following the GST reduction, people are expecting a turnaround. I think we'll have to really look at how it pans out. I think the aggregate sales number for the FMCG companies would be in the region of 4 to 5%. The larger companies such as HUL and all have actually seen a very flattish kind of volume growth. So while there is certain expansion in margins, it is also consonant with the overall commodity trajectory. So if there is a hardening of it, there can be a pressure out there. I would say, as I said earlier, it will be important to really look at what has been the trajectory during the festival demand. What kind of demand has been there during the Dussehra and the Diwali season? According to me, various the channel checks that we have done, it looks to be a mixed picture, as I said. And basically, people are saying that, or companies are saying that it is initial impact of the GST implementation, which is kind of creating a certain friction. They are expecting better scenario in the wedding season. We'll have to see whether it translates or not. We'll keep on tracking this. We have done it for paint industry. We have done it for the innerwear, for garment companies, etc. We have seen. We have looked at multiple such industries. So
Right.
it doesn't look like it's a runaway right
Got it.
away. But we'll have to see what is the scenario in the coming months.
All right, so we'll wait out and watch out how the wedding season pans out for these FMCG names and other channels that you have just highlighted. But Parag, just wanted to come to you for a quick question. What's the outlook for the auto sector? The trend that Mr. Sinha just highlighted, do you think that's going to persist for the auto sector as well? Because festive demand is done, so are the GST cuts. So going forward, what's the outlook for the auto sector? Very bullish on the back of wedding season, or could growth slow down there?
No, so basically, we entered into TVS Motors and Mahindra kind of stocks very early, and we have booked profits just for the because we felt that this GST-led momentum in the stock was too much, and we would like to wait it out now because the valuations have gone stretched. But I would like to say that see, whatever government and RBI has done, that was a most required thing, because India had a very stable macro all throughout, whether it is current account deficit, fiscal deficit, inflation, everything, corporate debt to GDP. The only thing which was required was a dose of or a stimulus to drive demand, and which was done by government by increasing the income tax slab. Then, of course, GST cut came, and in between, RBI cut repo rates by 1%. So I would say that this was very much required. It has given a sentimental boost and at least a 2 month cheer in auto companies and various consumption items. I would like to say that eighth pay commission plus marriage season, I think things should continue in my view. But as a cautious stance, we have booked some profits into this rally, especially in auto names.
Okay, so that's the outlook when it comes to the auto sector. Mr. Sinha, thank you so much for taking your time out and joining us here on ET Now. But with that, it's a wrap on this edition of the show. Thanks so much for tuning in.